Good morning, everyone. Thanks for joining us. So I'm going to start off by asking you guys to introduce yourselves. Do you want to start, Dan?
Sure, I'm Dan Held. I've been in the crypto space for about 10 years. People might know me for my content about Bitcoin or my last corporate role where I led marketing at Kraken.
Hi, everyone. I'm Michael, Senior Vice President, Global Head of Sales for Bullish, based in Hong Kong. Been in the space since early 2020, when we were just a small startup building what is now an institutional exchange called Bullish.
Hi, my name is Niklas Kunkel. I'm the founder of Chronicle Protocol, which is the Oracle protocol that secures over $8 billion of TVL in DeFi. And my background is being part of the founding team of MakerDAO back in 2016 until we founded Chronicle about 1.5 years ago.
And I'm Oliver from Landsberg-Sadie, the founder and CEO of BCB Group. My background is in investment banking. And my mission is to make sure that every legit crypto business in the world gets a bank account that doesn't go away.
All right, so we have a very, very broad topic. I'm going to start with the past. I'm going to ask you guys to vent a bit. How has the past year been? Are you fine? Like from 1 to 10?
The past year, I mean, I've been around a long time, so I've seen the all the way back to the 2013 cycle where we had the Mt. Gox collapse. At the time, Mt. Gox represented 90% of all trading volume. I mean, I think people forget how devastating that was. That was pretty dismal. Also, crypto was considered just money for drug dealers and money launderers. Crypto was not well respected. There was no institutions in the space. There's very little content. Other than a few prominent individuals like the Winklevi, no one really cared. I think when we look at the last year or two, crypto has really evolved over this time to become a very mature, and in my perspective, quite mature where it came, from where it came from. So I think we've seen institutions validate it. We've got a lot of enthusiasm with the Bitcoin ETF. That's huge news, including big institutions like BlackRock coming in with that. So I think while we're in a bear market, we've never been in a better place, I think, in terms of visibility and credibility in the space.
Michael, how's it been for you? Because we don't have a 90% concentration, but we do still have like around a 60%, which is quite big for a market, right?
I'd say if you were to say 0 to 10, 7 maybe. I mean, it's been a tough year for exchanges and just lack of volumes, lack of volatility. There's a lot of, I think, kind of sentiment from I guess the group around just kind of regulatory scrutiny happening out in the US. But in Hong Kong, where I'm based, actually it's been quite exciting. Things have actually kind of turned 180 since last year. And so there's been kind of like a certain amount of positivity that's coming through from that side of things. For us as a business, it's also been one where the narrative has kind of been, I guess, kind of pulling forward a future where we felt having trusted counterparties is quite important for that next stage of adoption. And so that's really helped us in terms of the way that we've been thinking about continuing to go to market, because we're just approaching the 2-year mark, so we're still relatively new to the scene.
7's not bad, I guess. And Niklas?
I think it's been quite a positive year, actually. If we reflect on, I think we called it the boom bust nature of this industry. The downs aren't as extreme anymore, right? They're much more buffered through every cycle that we go through, right? I mean, Dan, you mentioned the Mt. Gox hack, right? We can talk about the DAO, right? Hack as well, right? Where we're talking about an extremely large magnitude of the entire ETH supply, right? And an entire chain getting forked, right? And what we're dealing with now it seems more like a hiccup, right? You kind of have global markets going risk off, right? And that includes venture funding, and that has kind of caused, especially the B2C dApps, to kind of struggle a little bit. But in order to kind of fill that vacuum, you've kind of seen the chains step in, right? So the chains were able to raise a lot of capital in the last cycle, right? And they have very, very deep token treasuries. And they're highly incentivized, right, to grow ecosystems, on their respective chains. And so they've kind of stepped in to fill the void left by venture capital firms, right, to fund those ecosystems. And so I think there's a kind of a asymmetry between maybe what the narrative is and actually what boots on the ground kind of looks like in terms of there's an order of magnitude of dApps that are just in biddle mode right now that are going to be launching over the next 6 to 12 months.
Oliver?
Seeing that growth, it's amazing. For me, out of 10, 6 to 12 month scale, I think a solid 9.5. And I don't think that's priced into the markets yet. And I say that not to diminish the trauma that we've faced in so many ways, markets up and down, companies coming and going. But in the fact that despite the relentless near-death experience, Celsius 3 Arrows, Terra Luna, FTX, Silvergate Signature, we're here. And every monster we slay makes it easier to slay the next one. So I'm very positive about the direction because it is clear, I hope, to everyone here that this is a one-way street, that the upgrade of money and economy and how we do things is one way, but it's a little bumpy on the way. But I'm encouraged that we're here and that every one of these crises gives us the tools to deal with the next.
So, Niklas, you said it's a hiccup. How long can the hiccup last? Does it depend on the type of sort of business you're running or project? Because obviously, if you run an exchange, volumes are down and you need volumes to make money. And it's sort of, I guess everybody needs money to hire people, and many firms are firing people. So how long do we have left? Like, I guess you said there are companies that are going to launch, dApps that are going to launch, but how many are at the end of the runway?
To your point, right, you do see some, let's say, natural extinction, right? And this is primarily a symptom of overinflated valuations in the previous cycle, right? You have a company or a project, right, that raised at 200 million or something. The investors want to see a multiple; they don't want to see a down round, and so that company is going to struggle, right, to kind of continue to raise follow-on financing, right? But if you look in terms of new companies, in terms of seed stage funding, the majority of financing that we see right now from the investment side is on the seed and Series A, right? It's not on the Series B, Series C, Series D. And that's where the real innovation is happening.
Michael, what about from sort of the exchange perspective? How long can volumes remain this sort of depressed?
I really hope not too much longer, right? But I'd say, it's one of those things where the last couple of quarters, we've really felt, I guess, the need to kind of just think about, well, how do you just run a business when it's in a period of stagnation and there isn't a lot of kind of hope in the near-term horizon? And to be honest with you, I don't think it's necessarily something that's specific to crypto. I think it's just general business management and practice, like manage your costs, think about how you're going to grow, build products customers actually want to use. I think there's an element of this whole season that really helps, I guess, kind of this longer-term innovation trajectory. I'm a big believer that, when the tide kind of receded and everyone was kind of not, I guess, kind of just seeing money sloshing around, people really are pressed to either you build stuff that has commercial viability or you don't, and you don't survive. And I think that's been the critical difference between invention versus innovation, right? As in, invention is something that's just, novel. Innovation is when you actually find a real commercial use case for this thing, and that people find value and are willing to pay value for it. And I think that's helped to push people along. And I think, for us, as much as we'd like for the environment to get better, I think we found ourselves in a position where we've tried to be disciplined as much as we can to ride this out. And I think we've seen others in the space as well. And I think they're generally signs of good people that are in the industry, players that are trying to build this for the long haul. And I think that's really what we're wanting to see, is just people survive building this thing, doing the right things. Hopefully when things get back into a bull market, that we're going to see, I guess, kind of an upgrade as well, just in general, of the products that are on the market for consumers and customers, et cetera. So,
Oliver, did you want to add in?
No. Yes, always, but
we can.
Yeah.
Dan. So you've been through different cycles, right? You said 2013. How is this one different? I mean, you mentioned it's better. Well, is there anything that was tougher or anything that, that's,
I mean, when we look at crypto cycles, it's one of the hardest sort of industries to build a business in because you've got a monsoon versus a drought type mindset. In the bear market, it's a drought. There's no rain, you got to cut expenses, you got to cut down to the bone on headcount. My former employer, Kraken, I haven't been there for a year, went through layoffs where they cut like 30% of people. That's pretty extreme for most other industries, but in crypto, I think it's very appropriate. Coinbase, Kraken, and other legacy players in the space have been around since the 2013 cycle. They've seen how deep you need to cut in the bear. But in the bull, how do you plan for the bull? And that's where your expenses might triple or quadruple, your headcount will do the same. And that's what's really tricky is, if you've got that too bearish mindset, you might not apply yourself in the bull and go allocate capital and go grab market share when the bull run comes back. In terms of how this cycle is different, I mean, honestly, this feels quite mild. I've traveled around the world. I was just in Korea, Singapore for Token 2049. I've got this conference, another one, and then also Bitcoin Amsterdam. From what I'm seeing on the ground, there's still tons of businesses being built. Lots of interest from people wanting to build, join companies, or just interested in crypto in general. So I think this is a mild winter.
If I can attempt to connect these 3 points, I think there's two that's about the quality of innovation, and one about what it takes to be the right size of cost versus revenue to survive whatever it takes. And I think in the past we've seen a lot of amazing innovation solving problems which don't really exist yet. And I think the ratio of solutions to problems is a lot healthier now. And when we go through these bear cycles, we have to figure out what is the right size and shape of your organization to push through. It is the narrowing of scope to those solutions which really matter now. And I think we've seen a lot of that. I think people are building things that are much more immediately relevant and less esoteric.
So one of the things that does seem a bit different is sort of this really aggressive sort of regulatory stance from the US. We had warnings in the previous cycle with ICOs. They did go after some ICOs, but now they're like the SEC in particular is kind of going after everyone. So how has that impacted kind of either your business or your sector? I guess in your case, it's probably been good, right? Because people are looking for more regulated counterparties, but
I mean, I'm looking forward to a time when we have consistent, globally coherent, rational regulation. I think what we saw in the last 6 months in the US was a non-discerning hostility towards the market, which is really anti the trend that we're looking for, which is for European, UK, Singaporean, US regulations to see eye to eye on what a thing is, how to protect the market with that thing, how to make sure that money going in and out of that thing is not from crime. All of those building blocks of regulation, I think have taken a small step back this year with that with that SEC kind of outlook. But yes, within that chaos is opportunity, not just to be able to service that variety of regulations, but also to be able to feed back into the system and to be visible with a voice that points out what those differences are so that there's a chance that they do reconcile.
Niklas, what about from your vantage point within the industry?
Sure. I mean, I think you kind of see two things. One, it's unfortunate that the U.S. has kind of taken this more aggressive stance in the last couple of years, but it's clearly a very partisan issue in the U.S., right? And so, U.S. policy on this can change rather quickly, right? Especially with an election cycle coming up. The other thing that you kind of see is almost like an immune response from the crypto ecosystem, right? So. If the regulators go after someone, right, and they use a certain kind of language, right, to put a protocol or a project in a certain position, everyone else notices that, right? And now builds, almost like around that, right? And carves out that piece, right? And so I think you're seeing a much more like defensive and thoughtful building at this time, right? Especially, like it's almost a privilege to be building right now when there's not this euphoria with a bunch of users coming in, because it allows people to not have to rush, right? It allows people to take their time and build things thoughtfully and the right way, right? In preparation, kind of like what you were talking about the timing, right? To set yourself up for the next cycle, right? That they're now preparing, right? That they will have the right architecture, right? The right design, the right incentives, come what may.
Michael, the Hong Kong regulators have taken a different stance, right? They've been a bit more friendly. How has that impacted sort of the vibe there? I guess now there've been some scandals recently, but like, how do you notice any difference coming here, or like going to the US and you have some of your colleagues in the US?
Yeah, so I think what's been interesting is, so this year I've also kind of had the chance to go to different spots around the world. And what I've found is wherever there's been kind of this movement towards regulatory clarity, there is an improved confidence around just how do you navigate this stuff. And I think people just want to understand how that works. I think Hong Kong's been really great around, last October, there was, kind of a very coordinated message from the government and the regulators that they're going to make Hong Kong a virtual asset hub. And it was fantastic rhetoric, but most people were wondering, well, will they deliver on this? And I think what's exciting is that they've delivered on quite a bit, including basically a regime now that allows people to be properly licensed, and also that opens up for retail, which is kind of exciting in Hong Kong. I think there's also been a really well thought through approach around this. I was talking to one of the regulators and I was saying, hey, it's great when you've got, let's say a license plan and this path towards it. But if you don't have banking rails, for example, it's kind of like having a Porsche without a highway to drive it on, right? It's like, you kind of need the whole ecosystem to make this work and be successful. And it's been very neat to see the HKMA, for example, being very encouraging to the banks to say, hey, don't have this allergic reaction to banking crypto companies just because they're crypto, right?
Which is not happening here by comparison, right?
Well, but it was this idea of like, you should judge them on their own merits, right? They're technology companies, and this is something that we want to provide, to the banks, certainty around, for example, how they could be regulated and properly licensed to operate in a way that is, suitable to the way that, they want to develop this industry. So I think it's been a generally positive thing in Hong Kong. I think in the last probably week or so, we're starting to see the MAS starting to kick up again. There's been a lot of people announcing licenses recently in the last couple of days, which is also exciting, right? To see kind of that regulatory clarity coming through and momentum starting to happen again.
So there's a Slido question, which incidentally matches with what I wanted to ask, which is great. What are some of the biggest lessons, or what is your biggest lesson that you think you've taken from this cycle?
Well, I think a few of us touched on this before, which was you should build products that solve problems. I think in the bull run, you see a lot of excessive funding of shiny ideas that might resonate, but not really solve a customer problem. And so I think what we see in a bear market is when that tide comes out, what is actually solving a problem, what teams and companies are effectively allocating their capital to go build great product. Those are the ones that are going to be left. So, yeah, I mean, it's pretty basic. Just build products that solve problems. It's actually funny because in crypto, there's so many solutions for hypothetical problems, but I've never seen an industry with this many solutions for hypothetical problems. So I would say, just basic product building, solve problems for your customer.
Yeah. If I could maybe
go ahead.
build on that a little bit. One particular framework that I found super helpful around this is this idea of jobs to be done. So it's by this famous business professor from Harvard called Clayton Christensen, right? And his whole thing was go beyond the correlational aspects of things and try to understand causality. What makes people think that this is the best alternative that they're willing to pay money for, to hire for the job that needs to be done? And I think that there's this element of pushing that envelope around how to build products and how to build things into this space. And I think it's, kind of diverting that attention, because there's a lot of brilliant people in this space. having them solving for these real life problems and coming up with solutions, I think that would really help to accelerate kind of when things start to pick up again.
Oliver, do you have a lesson learned?
Yeah, gosh. I think the crypto industry is still seen by many as kind of anarchic, chaotic, stick it to the man kind of economy, and it does a good job of giving itself a bad name on a regular basis. I think lessons learned from bear markets, that there's a bunch of stuff from TradFi that has either been forgotten or ignored because TradFi. Basic counterparty credit risk management was absent. So much so that one of the acronyms floating in the last year or so, it was lost on somebody that it actually related to that basic concept. RWA as a real world asset, it's actually risk-weighted asset. It's how you protect your balance sheet. It's people have not been thinking about the credit risk which collapsed so many businesses last year, to the extent that you had token companies offering yield, and in exchange for your deposit, they'd collateralize it with their token, doubling up your risk. It was absolutely nuts. So, in a nutshell, I think there's TradFi has maturity and the kind of models and frameworks that didn't happen by accident, and that ought to be observed and not copy-pasted directly. And there's a lot of stuff that's irrelevant in the crypto market, but that a lot of a new generation of crypto engineers should look at and build in fundamentally. And that's, I think, what's been missing in the last bear market. Every bear market you can trace that's a market risk failure, or that's a kind of a basic DD failure, or a credit risk failure. So let's not ignore what TradFi has actually taken decades to build.
And if I could add 2 cents to that, I think there was excessive risk in the crypto ecosystem. And I mean, some of these lenders were just egregious with how they assess their risk, where they're taking so much risk on one counterparty that it would wipe out the cumulative profits of a decade-old company. I mean, why would you take risk like that? It's insane. I would consider, most of the risk management in the space was negligent, I think is probably the appropriate term. Even the smartest people in the room, different companies that we consider to be the best, they failed to perform the most basic of risk management. Of course, you had the big Celsius blow up, and those that we all kind of suspected were going to be a little bit, egregious. But I think that was pretty shocking to me, is that there were a lot of, the risk taking was so excessive that I couldn't even 3 arrows, the whole gamut of all of them. So I think that really truly shocked me.
How many people were calling out the excessive risk-taking at the time? Because I've been covering it since when you were around, and during bull cycles in crypto, everybody's happy, everybody's making a ton of money. You don't want to point fingers and say, hey, that guy is taking on too much risk, because somehow you might be connected to one of your clients. And so do you think actually now people have implemented proper practices to manage counterparty risk? So if, like, say tomorrow some other narrative takes off and volumes start going up and lending starts going up, you have those practices in place? Or will they only come in place if someone tells the firms you must, otherwise you're going to jail?
I have direct visibility of this because when you're onboarding with a trading counterparty or a bank or anything, you've got your onboarding pack, your KYC, AML, the structure charts. What I'm super relieved to see now is the reverse DD. For the longest time, you could onboard with somebody, and that would, but you wouldn't check them, which was absolutely nuts. Onboarding with each other as trading counterparties or as banking counterparties or whatever it is, is a two-way DD, and we're starting to see, when we've got a new client onboarding with us, they're asking us the right questions now. Like, thank you, here it is. So yes, we are seeing more signals of credit risk being taken into account.
Michael, what about from the exchange perspective, right? Or just from like a market's perspective, are you seeing people putting in place the right things so that if sort of things take off, if they are offering lending or margin, it's done with more checks or like I don't know, even hiring people who've had experience in this? Because in some cases there were like people doing checks that had never done it before.
I mean, it's kind of like what Oliver's saying, like the trend of more two-way DD happening has increased. I still remember like the week of FTX, all of our clients sent me 20-page questionnaires that I needed to fill out. And it was one of those things where thankfully we had a lot of the answers like ready to go off the bat. But it was very clear that everyone was trying to basically catch up on what they had not been doing, which is, trying to really dive deep and understand, to what level of transparency do people have providing, for example, things like finances or whatever it might be, right? And so there was a big rush for, I guess a couple months around proof of reserves. That's kind of tailed off a little bit recently. But on our side of things, we were kind of like fortunate. We said, hey, actually, we've got an audit from Deloitte. Do you want to see that? And they're like, we didn't even know that that was a question we could ask. So, there's been more and more scrutiny around this, which I think is generally good. It also, I think, converges closer towards, what best practices people have when they're managing billions and trillions of dollars, which is kind of where we need to go to, right? That's what we want to see, right? I mean, it's funny, the other day we were sitting in Token, and our CEO was sitting next to the CEO of Franklin Templeton, and he kind of did a friendly reminder. This lady over here manages $1.5 trillion, which is about the market cap of crypto, right? So there's an element of there's a next stage that we're all going for, and I think that this pushes the maturity towards it, and I think it's a good thing. People are starting to ask more questions, and I hope that the industry keeps up in terms of being able to provide the transparency that's being required.
Niklas, are you going to add something?
Yeah, so I think one of the things that's kind of ignored is how successful DeFi was during this kind of downturn that was triggered by this lapse of risk management, right? When you saw the CDFi lenders like BlockFi and Nexo and Celsius kind of blow up, right, due to the contagion, did DeFi blow up? No, they didn't. And actually, these same CDFi kind of companies, right, which were some of the biggest users of these DeFi protocols, did they pay back their creditors? No, they didn't. But guess who they paid back? They paid back the DeFi protocols, right, to unlock their collateral that they had stored in those protocols. And so I think it has to be said, like, how impressive it is that DeFi was able to make that jump from the previous cycle kind of beforehand, where you saw, I think probably Cream Finance is a good example, right, of a DeFi protocol, right, that was just had outlandish risk management, right, and eventually just became insolvent, right, versus other DeFi protocols kind of learned from that example, took very appropriate risk management in the previous cycle, right, and you did not see Aave blow up, you did not see Compound blow up, you did not see MakerDAO blow up, and I think that that should be celebrated a little bit more.
Yeah, I think that is really underappreciated by TradFi, who kind of see DeFi as this big miasma of WTF. It's coded incentives. It doesn't rely on any human's finger on the button to send or not send money, to apply or not apply a yield. It is a market-driven open box thing that you can DD by looking at the code. And yes, that brings its own risks and shortfalls, like platform risk and protocol risk, and like we still haven't really solved the anonymity versus privacy problem in DeFi. But yeah, I mean, to your point, it's there's fewer dragons in DeFi than you'd imagine.
I think there's a little bit of nuance here where DeFi, we've reduced counterparty risk almost to zero, which I think is a huge, incredible achievement. And I love the promise of DeFi, and I think that's what we're all working towards in this space, is we want to build financial architectures that are decentralized and remove that human finger on the button. However, I think it'd be remiss not to bring up all of the protocol risk involved, which is quite substantial. The amount of hacks and exploits that have occurred in DeFi are, I think, enormous. But I don't want that to overshadow its capabilities and its future, but I think that is something important to note.
So what are some of the things that need to change? You brought up hacks, so I guess security, but some of the building blocks that still aren't there if you want to get a big institution to go in heavy. Is it they just don't? Is it there's a lack of narrative now? Is it, we're missing some, is it the regulation? What are the things that really need to be in place still that aren't missing?
So liquidity is still such that you can take spot risk, but you can't hedge it. I mean, there are options out there, but the market, oh gosh, I was surprised to learn this gigantic stat. There is actually a gigantic options market, to my surprise. But to get TradFi engaged in that risk management component of the markets, we need a crypto ISDA. Because right now everybody's got their own structure, and it's all kind of similar, but a standard master agreement that the world can agree on for these instruments would enable large tier ones to engage on a common understanding.
Yeah. Regulation, infrastructure, scale, kind of like top three that come to mind. I remember I was speaking to a sovereign wealth fund in Asia recently, and he was like, well, if I allocated 1% to this, it would just completely blow out kind of, the guardrails around, how much I can be in the market type of thing, right? Like if I can't actually deploy enough to make it meaningful at the moment, why would I spend all of these very precious resources in terms of people and time to figure it out right now? So there is a little bit of a waiting game around that, in addition to also the things that I mentioned earlier around regulatory stuff. So, yeah.
What about users, not of the tokens, and so not investors, but users of the protocols, users of these products that everybody keeps building every cycle we're building? Like, does that matter? Like, do we need at some point to have someone use this beyond? I guess the DeFi protocols get used again within the financial sphere, within the trading sphere. But does someone need to use? Like, does Filecoin need to have a lot of users using it for what it was supposed to be made, or does that not matter anymore?
Well, I'm going to take a little bit of a fiery take on this, but
Good. I'm trying to get you guys
yeah,
fired.
soft pitch there. So yeah,
Strap in.
the Bitcoin and all other crypto assets, the adoption has primarily occurred through speculation. 2013, 2017, and 2021. Now, speculation isn't this dirty word; it just describes human behavior. Humans will look at a new asset class and decide to speculate as to its future value. The same thing happened with equities when they came around. When people first started to come up with the concept of equity, in fact, the East Indies company, the speculative bubble that occurred from that, the Bank of England and England reacted so harshly against that they banned any new issuance of any new publicly traded company for 100 years. So speculation for any asset type has always occurred. With all of these protocols, I think what we're seeing is the token this sort of native token that you need like a Coke machine, or is it more of just a speculative instrument? I think most are just speculative instruments, and I'm not sure how many consumers are actually going to solve a consumer problem with these decentralized applications. I do think speculation is actually a utility. I think people want to borrow and lend. All market activities are speculative. Lending, borrowing, buying real estate versus other assets. So would people choose to speculate on new digital assets? Absolutely. And I think speculation is a utility.
So I'm going to take a slightly different take on that, and that it is that price begets narrative, narrative does not beget price. And that if you think about an application being able to get a certain fraction of the pie in terms of like the attention economy, right now it doesn't matter if you're getting 5%, 10%, or 20% of the pie. What really matters is that if once prices start to rise again, you'll have hundreds of millions of people around the world, right, pay attention to this space again, right? And at that point, if you can capture 1% of that pie, that is in orders of magnitude more kind of adoption than you can achieve even in the best of circumstances right now. The fact of the matter is, right, that the kind of common perspective of crypto right now is rather poisoned, right? We had a bunch of fraudsters, which that will always happen when there's easy money to be made, right? And that's kind of taken over the airwaves right now, right? We had Suzu go to jail in Singapore just this last week. We had the FTX trial of, or should I say the Sam Bankman-Fried trial, right? Start this week, right? And until we kind of resolve some of those lingering negative narratives that people associate with crypto, we're going to struggle a little bit. But as soon as those headwinds are gone, I really think that we're in a really good position.
How do you prevent these sort of situations from happening again? I think there could have been something that the industry could do as a whole. So I'm going to go back to the finger pointing. But if again the money comes back, will everybody be too busy making money to say, hey, look, that guy's a bit dodgy? Because there's as you say, the FTX trial starts this week. If what prosecutors are alleging is actually confirmed, there were some egregious lapses there, right? And so does the industry bear responsibility? Does the industry have to say sorry? There were lots of people who lost a lot of money, right? So will they come back, or will they be keep your coins and speculate on your own?
They'll come back. And unfortunately, to your question, right, what can we do to prevent it? A big factor here is human psychology, right? People want to look to experts, right? Especially if they have a lot of machismo and the like, right? And there's a lot of individuals that will take advantage of that, and if they see an opportunity, they will step into that vacuum, right? So just like we had the Do Kwons and the Sam Bankman-Frieds and the Suzus of last cycle and the Justin Suns of the previous cycle, we'll have a whole new crop of characters in the future, right? And it's really up to all of us here, right, to call those out, right? And self-regulation only goes so far, but it's still a critical piece.
Hindsight's 20/20, isn't it? So it's easy to look at some of the big events and think coulda, woulda, shoulda. I was completely taken in by SBF's nerd camouflage. I just didn't realize what it was camouflaging. And I think the difference between these failures and whether or not we can prevent them is that they are at a cadence that exceeds previous markets by, 5x. Which means that if the failures are at that rate, then so is the evolution and the success. And we're actually, this is the, I don't know, I think it needs to be allowed to fail as long as the direction remains one that is actually building something better, something that has a point. I think we all need to remind ourselves, what is the whole point of this? It is to upgrade money. It is to make things that have leaned on trust, trustless. It is to democratize engineering and access to financial instruments. If things are failing fast and building towards that, then hindsight is a kind of a moot point.
All right, we have 1 minute left, so I'm going to take the last question, which was, no, it's gone away, but I remember it, I think, is when do you think the next, this is a question, be hard to answer, but when do you think the next bull market is happening? What are your things you're looking for?
Well, I can make up a story for you, and we'll see if you
Rate
like
cuts.
it. But yeah. So you've got the classic 4-year boom-bust cycle, which is dictated by the Bitcoin halving. The halving is when the Bitcoin issuance schedule, so the newly minted Bitcoins, drops in half. That should be occurring in April 2024. Now, if you believe in efficient market hypothesis, we all know this is going to happen, so this should not be a shock. I think the halving is priced in for us who notice, but the rest of the world does not notice. Bitcoin does lead the market still. Otherwise, we'd see independent bull runs happening outside of Bitcoin. Instead, we see Bitcoin lead, then everything else follows. So I think Bitcoin dictates these cycles. And we should see, after the halving, it's usually 6 to 12 months after, that we see the peak of the bull run. So that combined with the Bitcoin ETF, combined with all the bad blood being washed out, combined with maybe some narratives that bring back in retail, I think a reasonable estimate would be end of 2024, middle of 2025.
Michael, have you heard of any compelling narratives? I've been trying to figure out what the next narrative will be, because sometimes behind the narrative hides the risk.
Yeah, I think one of the most compelling narratives I've heard was Dan just now. So I mean, honestly speaking, I think a lot of the stuff we've just discussed, it's kind of been bubbling, and some of these things just need to get solved for. I think there are some things that could be catalysts, but again, it's just honestly speaking, I'd be in the investor seat as opposed to the exchange if I knew exactly what was going on. But I think what Dan said is quite interesting in terms of what are some near-term things to look at that's fundamental to the way the industry is formed and how it's operating.
Niklas, is there anything on the ground that you notice starts to happen before a bull run that might be an indication?
So I don't think it's a ground-up type of phenomenon. I think it's more just that the people on the ground are ready. Right, they've built the stuff. They're ready for the big influx of attention, but I think it's more top-down. Right, I think the biggest factor is going to be U.S. elections. It's going to be U.S. monetary policy, and it doesn't hurt that lines up rather nicely with the Bitcoin halving. Right, so yeah, I would kind of agree that mid 2024. Going into 2025 should be some pretty good time for our industry.
Oliver, you have the last word.
As quick as I can.
Minus 1.40.
No pressure. Froth comes and goes, but it's also the most visible thing. The foundation, in the meantime, less visible, is growing. I'm going to mix all the metaphors now. But what we have is, in my view, a coiled spring. There's been so much purposeful build and having the right minds in the right room at the same time, that when the stars align, and I'll give my view on what that means in a moment, when the stars align, that coiled spring just explodes and we pop into bull market that where bull is actually wouldn't be the right word. It would be a healthy market. A healthy market is about 4 or 5x from where we are here today. And what is the trigger? I think it is a lowering of the weapons from the SEC. It is which itself is probably election-driven. So I think the middle of the US is probably the single spark that we need to get this thing back on its ground, back on its feet.
All right. Thank you so much, everyone.
Thank you.